All right, joining us to break down today's market actions, Michael Seery, president and owner of Seery Futures. He joins us from the CME Group, and Don Wordell, portfolio manager at RidgeWorth Capital Management. Don's $1.65 billion fund ranks in the top 1% for performance in the last 5 years. That's very impressive. Don, let me start with you here and ask you about earnings, because you say earnings beating expectations are your catalyst for getting bullish. But don't they almost always beat expectations?
Yeah, this week we saw that. We saw a lot of companies beat expectations handily. But what's interesting is, with the banks, we had a lot of bank earnings this week.
I was going there next.
Those companies. Hello?
I was going there next. No, I was going to say I was going there next. I mean, it's a little bit scary when you see that revenues at banks, they do not beat expectations, and in fact, they're a little bit depressing.
Well, but you're seeing stabilization in credit, and you're going to see some loan growth over the next, call it 12 to 18 months, where you contrast that with a company like Apple or Google, whose revenue expectations can't get any better. So I'd rather own the low expectation stocks, and the market's telling you that, with the banks and the lower expectation stocks outperforming after the earnings announcements, and the bigger names not working so well.
Hey, Don, I've noticed this week and today in particular that even as the larger cap banks have been disappointing, the sort of mid cap and regional banks have been doing much better because they are more purely reliant on the trend you're talking about. I mean, when you saw BB&T, SunTrust, and Capital One all today doing quite well, the stock's doing quite well on earnings because of reduced credit losses. Is that sort of a subgroup within the financials that you're particularly looking at?
Yeah, if you really break it down between small banks, mid banks, and large banks, I'm much more attracted to the mid cap banks because they have multiple revenue lines, they have geographic diversification, whereas the small banks are really one-trick ponies that do mortgage lending and limited geographic diversity. And then it seems like the large cap banks are just got bullseyes on their back from Congress. So it's the mid cap space that we really find as being the sweet spot in the banking universe right now, with a steep yield curve, credit stabilization, some real loan growth, and valuations that are very attractive.
Hey, Michael Seery, let me bring you in here. It's Adam Johnson. It kind of feels like things have sort of slowed down on the S&P. In other words, we couldn't get through the 1,300 spot, and here we are, closing 1,280. What's the mood on the floor? Does it sort of feel like we kind of lost momentum?
I think we have lost momentum. We've slowed down. I mean, you're not going to go up too much in the first quarter of this year. Really, all the momentum is in the commodity sector, again, except for gold. It looks like liquidation in the gold market. But I just think the stock market is ahead of itself right now, and we'll be in for some down action here. I don't think anything major, but you're just not going to continue to go up and up and up. The expectations are so high right now that if anything comes bearish, there's going to be some profit taking ahead.
I find that kind of funny, Michael, because everybody we've been having on, at least at the end of the year, was saying, the first half of the year still looks good for the equity market. You've still got stimulus money floating around there. The earnings environment looks good. It's the second half we start to have questions about. I mean, did something change in the last week or two that kind of has changed that sentiment? Or are you just saying maybe a little bit of a pullback, but then we resume the upward move?
Right, and you still have low interest rates. We had 7 weeks of consecutive gains. This week we're down 0.6%, which is absolutely nothing.
Right.
There's very little volatility. The VIX is at 17. You just can't go up every single day. There's got to be a pause at one point. And this isn't even a pause. It's only 4 days. We only traded for 4 days this week. So I just think it was a nothing week. I wouldn't put anything into it. The momentum is still on the upside, but as the higher we go, it's going to get tougher and tougher to keep it going. I mean, the expectations are so high.
And I guess, Don, the question going out to you is, are you buying into this? Again, these names are up. They're going to start reporting earnings over the next couple of weeks. Do you want to own these oil exploration names ahead of the earnings? And do you think oil legitimately goes above 100?
Yes and yes. I do believe that oil is going to move higher over the next 2-3 years just because of global demand. It seems like there's just no end to the demand for global energy. And I also think you want to own the exploration names. I agree with that. I agree with that thesis. As you also want to be focused on the names that have returns-based capex spending, though. The names that are really outspending their cash flow could run into some problems with investors as they have to sell assets or raise debt. But the guys that are returns-based, really focused on returns that are greater than their cost of capital, are the stocks that I think will do very well over the next 12 to 18 months.
Hey, Don, that's a key point. In other words, paying for your drilling budget out of cash flow. You're not issuing bonds to do it. You're paying for it out of cash flow. What are some of the names? I know guys mentioned Concho Resources as one name that does that. What are a couple other names on your radar that fit that bill?
Right. In my world, my favorite name for that is QEP Resources. It's a it's a smaller name. It's around $6 billion in market cap. It was a spin out from Questar Corp last year. These guys need $42 oil to earn a 10% pre-tax return on investment in their Bakken play up in North Dakota. So I really think that those are the kind of names you want to be focused on. Names that really focus on the returns and spending and staying within their cash flow. Another one would be Talisman. You could look at Talisman. It's the names that I don't like, names like Chesapeake, where they're having to sell non-core, sell assets to pay down the debt and to raise the money to. Eventually, they're going to have to sell their good assets, or they're going to have to raise equity and dilute their shareholders. So, we really like the returns-focused guys.
Hey, Don, it's Julie here again. When you look at whether you're talking about oil companies or anything commodity-based, how much of a risk is China right now? I mean, we just heard Zara talking about the Chinese New Year coming and the expectation that perhaps rates there are going to go up again. Whenever that's happened over the past, several months, or when they've raised reserve ratios, we've had commodities hit particularly hard.
Yeah, and actually for most of the companies it wouldn't be such a bad thing if commodity prices were to sell off a little bit. There's many of these packaged food companies that are just struggling with trying to pass through higher wheat prices and coffee prices and sugar prices, and so it wouldn't be such a bad thing if commodity prices were to sell off in the near term. I think China is very important. China is going to be the engine of global growth for the next 5, 10, 15 years. But a short-term pullback in commodity prices wouldn't be the end of the world for a lot of the companies in the mid-cap universe.
Hey, Michael Seery, I want to bring you back into this. I've got a viewer writing in, Dave, and he says, look at what happened to the Russell, the Dow Transports, and the NASDAQ. They're all aggressively down on the week. Let me throw some numbers at you. The NASDAQ's down 2.4%, Transport's down 3.5%, and the Russell's down more than 4%. So I know we kind of brushed off what we saw in terms of the S&P decline this week, not so much.
Right.
But factor in those three. Those are big moves to the downside.
Well, those also, the Nasdaq's had a bigger run. The transports have had a bigger run. So on the downside, they're going to get hit more than the S&P. I mean, the Nasdaq's had a heck of a run in the last 3 or 4 months. So any downside action, they will hit it. But back to that China thing, 4 times in the last 4 months they've done it. The commodity market has sold off tremendously the next day. But then all that happens is we even move higher 2 or 3 days later. And that's what happened here yesterday. We sold off tremendously. A lot of prices rebounded again. I think traders are getting used to this trick. China raises rates. They sell off one day. You buy it, and they'll come right back.
All right, but I want to go back to those declines. You're just going to blow them off completely. I get it, what you're saying. They've had a strong run, so they're going to have a stronger move to the downside. You blow it off completely.
Yeah, I don't think it means anything. That's strictly what it is. The higher something goes up, the lower it's going to go, and the NASDAQ and the transports have had great runs.
Don, that doesn't bother you at all in terms of the moves on the NASDAQ, the transports, or the Russell this week?
Well, and I think it's really, the NASDAQ move is probably, how much is Apple of that, and Google. Both of those stocks were down big and probably brought the index down. And then Union Pacific probably drove the transport index down. So I really think that the other guest was absolutely right. It's expectations. I mean, some of these stocks have got such high expectations that they're not going to be able to report earnings good enough for the market in this environment. And so, they just need to settle back and consolidate somewhat.
All right, and that brings us full circle to your first point. Don, thanks so much for joining us. Don Wordell there from RidgeWorth Capital Management. Michael Seery, we appreciate you joining us as well.